Hello there, everyone. I'm Dave Keller with Sierra Alpha Research, and thanks for joining me here on my weekly show on StockCharts TV. Today, we're going to talk all about sector rotation. I would argue that going into the election season here in the U.S., and then certainly coming out of the election season, we've seen some somewhat dramatic changes in the sector rotation picture. Certain areas that had been leading starting to lag a bit, certain areas that had started to emerge beginning to accelerate, and some new themes kind of coming out of it. Sector rotation is such an important part of the institutional investor toolkit, I would argue. Think a lot about, which sectors, which industries, which groups stand to outperform and underperform given different market conditions. And I would argue that individual investors could certainly stand to upgrade their awareness of this particular area of the equity market. So today we're going to talk about three tools that I use on the StockCharts platform to track sector rotation. We're going to talk about relative strength analysis and essentially looking at how sectors are performing relative to the benchmarks and what sort of initial takeaways we can develop. We'll talk about offense versus defense and how traditional areas, certain areas of the market have kind of a traditional offensive or defensive implication, and we can use that to assess broader conditions of risk appetite. And then finally, we'll look at one of my favorite visualizations that has been created in the modern investment age, the RRG, the relative rotation graph, created by Julius DeKempener. I'll show you how I use that and some of the initial takeaways I can tell you about here in November of 2024. All right, so looking at the charts here, we can see, looking at the chart of the XLY, and I'm looking over the last 2 years, I'm looking at RSI as a measure of momentum, and I'm looking at the consumer discretionary sector relative to the S&P on the bottom. So the reason why I want to start with the XLY, this is one of those sectors that has really changed its sort of configuration from right before the election to right after the election. Now, Tesla is one of the three biggest weights in the XLY. Tesla gapped higher in a big way post-election with Elon Musk's involvement or potential involvement with the Trump administration. As a result, the XLY certainly popping higher. And other stocks like Amazon obviously are doing okay as well. So that rally has caused an improvement in price momentum. And RSI is my favorite measure of price momentum. This essentially looks at the strength of up days and down days and essentially shows you how the stock tends to trade or how the ETF tends to trade day in, day out, and then when we're at sort of an extreme reading of upside momentum or downside momentum. So we're recently coming out of an overbought condition because of that surge that we saw coming out of the elections earlier this month. What I want to focus on is the relative strength, because when you think about sector rotation, the implication, right, to that phrase is that there is a set amount of capital that is in the U.S. equity market, and then it's being rotated around from different sectors like consumer discretionary, energy, financials, real estate, kind of rotating around. So the idea is it's less that money is going in and out of equities, but more money is in the equity markets and is rotated around these different sectors. And this really comes from the practices of institutional investors, traditional money managers, which tend to be all in. They tend to be fully invested. They don't tend to do a lot of market timing, meaning they're not invested in equities and then out in cash. They basically just rotate to different areas of the equity market because their mandate is to remain fully invested and have minimal cash in their portfolio at any given time. So that is sort of why sector rotation is a thing we even talk about, and that's why it's something that we track. And to be honest with you, one of the brief history lesson, I remember talking with who was I talking with? Someone talking about Walter Deemer, the great Walt Deemer, who was the technical analyst at Putnam Investments in Boston in the 1970s. When I spoke with him years ago about sector rotation, he actually came up with this idea of looking at the Fidelity Select funds, which are a group of sector and industry funds, really predated a lot of the sector ETFs that we're going to be looking at, the sector spiders. These were, predated them by many years, and you actually had to buy into the Fidelity Select funds as a family. You'd have to deposit your money in this family, and then you couldn't really pull it out. You're restricted on how much you could pull it out, so you had to actually just rotate. So he actually did a weekly report where we would track the flows between the select funds. And so talking with him years ago really helped me think a lot about about this particular kind of analysis. So shout out to the great Walt Deemer, a good mentor to me and many other of the Boston technical analysis family, I guess. All right, so the idea with XLY breaking out and the strong momentum, it really fuels an improvement in relative strength, meaning the XLY is outperforming the S&P 500. And that's what's most vital. From mid-August to now mid-November, the relative strength has been trending higher, meaning over the last 3 months, if you own the XLY, you're getting a better return than the S&P. So that's just setting the table in terms of what sector rotation really means. It's investors rotating their assets between a bunch of different sectors, and relative strength is probably the most important way to track those movements because it recognizes that the benchmark is doing one thing, but I want to see which sectors are doing better than average or better than the benchmark returns. So how can we actually analyze these over time? Well, the first thing I would tell you about is just looking at a series of relative strength lines, right? And this is part of my Mindful Investor live chart list. If you go to marketmissbehavior.com/charts or click on in StockCharts, go to the articles tab and click on my blog called The Mindful Investor. You will get to a link for this live chart list. And these are 3 of the charts that are actually on that live list of charts that I keep updated on the StockCharts platform. And I'll try to remember to put a link in the description if you want to access those directly. But basically, I'm looking at 3 different groups of these sectors. And so when you think about the 11 S&P sectors, you can group them by certain qualities. And there are different ways to group them, to be honest with you. But this is the probably oversimplistic way that I tend to do things, which I tend to try to simplify as much as possible in my own process. So the first group of sectors I look at are the growth sectors. These are sort of the Magnificent Seven sectors, the FANG sectors, right? Sort of those new economy kind of names, although there's other things included in there as well. It's technology, communication services, and consumer discretionary. So each one of these data series is looking at the relative performance. So this top panel is the XLK versus the SPY. Here's XLC versus the SPY and XLY. So those are the 3 sectors that I'm looking at. So if these lines are going up, as you can see, like here in mid-2023, that means all 3 of these growth-oriented sectors are outperforming the S&P. And when they're going down, like you see the XLY, the first half of this year means it's underperforming the S&P. So look at just the far right side of this chart. This is a 2-year chart, but I'm really just thinking about what's happened in November, right? Because kind of going into the elections first week in November and now coming out, what sort of themes are emerging post-elections? You can see that technology, to be honest with you, has not really rallied a lot on a relative basis. It's actually been basically in line with the market. And not just in November, it's actually been pretty much in line with the market since July. And that's what it means when the relative strength line is perfectly flat. That basically means it's not outperforming, it's not underperforming. It's kind of just a market performer. It's in line with the major benchmarks. Compare that to communication services, which has made a new 12-month relative high in November. Compare that to the XLY, which has made a new relative high for the year here in November. So these are sectors that coming out of elections have really started to improve on a relative basis. And particularly the XLY, as I mentioned, Tesla is one of the biggest weights, and that's had an incredible run, even with a lot of noise here in mid-November. But quite a rally coming after the Trump victory on Election Day. So that's the first group of charts, the growth sectors. Second group would be the value sectors, and I kind of group these 4 together: industrials, financials, materials, and energy. And those are the 4 sectors from top to bottom. Now, the idea here, same idea, right? I want to see where we're seeing rotations. Now, the growth sectors, again, are sort of those new economy sectors, the FANG sectors. Value sectors are kind of more traditional cyclical sectors. These are kind of old economy names like industrial companies, heavy construction, building sort of tools and capabilities, financials, which would be banks and all of that, material stocks, and then energy at the bottom. Look at what has happened just on the far right side of the chart, and look in particular at financials that have surged to the upside, energy, which has surged to the upside, materials, which have surged lower, and industrials, which have been flat. So what's happened in the last month or two, really, if you look at the trends since, the end of September. So sort of fourth quarter overall, financials have improved on a relative basis. I would argue a lot of that has to do with the yield curve, right? You have the Federal Reserve lowering the short end of the curve. You have the 10-year point remaining fairly elevated in sort of the 4.5% range. And as a result, the yield curve is becoming steeper or more normalized. And that is how a lot of banks make money, by borrowing at the short end and lending out at the long end. So you can buy a house or a car or whatever. And so as a result, the conditions are basically getting more friendly for financial institutions. On top of that, Trump victory implies lower regulations for banks or lower regulatory pressure. So all of that is helping to contribute to some strong outperformance in the financial sector. And that's something we've been covering in our own work for a little while, but that's how the relative strength really tells that story. Industrials really have been sideways in the fourth quarter. You can see that energy has really not been that good, except in November, we're actually starting to see an improvement in relative strength in the energy sector. And what I would point out with energy in particular, that is usually, I think of that as a direct play on crude oil prices. So when crude oil prices are going up, that just tends to be better for energy stocks, obviously, because their businesses are getting oil out of the ground or selling oil so you can put it in your car or whatever. And so as a result, the higher crude oil price, the better it's going to be for energy stocks. So as crude oil has, maybe just started to bounce off of support in the 60s, we can see that energy has started to improve. And certainly a Trump victory implies better for old energy than renewable energy, things like solar stocks, which have been struggling quite a bit after the election. Materials have come down, and that's really precious metals in particular come to mind. Gold stocks have come down quite a bit. The stronger dollar has caused gold prices to go down, or certainly been a part of the gold price downtrend story. As a result, the materials sector has underperformed. Finally, we have the traditional defensive sectors, and I group utilities, consumer staples, and real estate together because these are sectors that usually are fairly defensive. Now, what makes these defensive sectors? Things like, powering your house, shelter, food, cleaning products, alcohol and tobacco, beverages, personal care products. These are all represented by these sectors, right? You need a place to live, you need electricity, you need food and water. These are the sectors that pretty much no matter what the economy is doing and no matter how much disposable income you have, these are sort of those basic staple things that you're probably always going to need. And so as a result, those sectors tend to do well regardless of what's happening with the broader economy, or they will tend to thrive. So when conditions are good, those other two buckets of sectors tend to do much better, and these defensive sectors kind of lag because investors or consumers have a lot more discretionary income. They have a lot more disposable income. They have money to spend, or they can borrow money readily, and as a result, they're going and buying, travel and tourism and new watches and new clothes and all those things that you spend money on when you have money available. When these sectors start to outperform, that usually means the opposite. That means conditions are probably not as good, and as a result, institutional investors are seeing an opportunity more in defensive sectors. Also, when the market goes down, defensive sectors just tend to do better, and that's because they tend to have a lower volatility, meaning lower movement. So if the market is getting uncertain, lower volatility means less uncertainty or lower risk, and they also tend to have a lower beta, meaning if the market goes down 20%, it's unlikely that these sectors would go down that much, because they tend to have a smaller movements relative to the benchmark. So if you are concerned about the market going down, if you're concerned about the S&P and the NASDAQ going down 10, 20%, these sectors tend to be good ones to own, sort of considered low volatility sectors, because they'll probably go down less than the benchmarks. And as a result, it's a good way to outperform in a down market environment. So what's happening with these sectors right now on a relative basis? They're all getting beaten down pretty good on a relative basis. In the fourth quarter, you can see utilities underperforming, consumer staples underperforming, and real estate underperforming. So all three of these sort of going down. So what sort of general takeaways can we sort of draw just initially from looking at these 11, or actually these 10? And there's one that I missed. Do you know which one I missed? I'll tell you in a moment. But basically, in terms of growth sectors, we've seen a resurgence in consumer discretionary, which is an important theme we'll come back to, and also communication services. On the value grouping, you can see financials and energy emerging as the strongest relative performers in November. On the defensive sectors, none of these are really doing well. So overall, this is a fairly bullish configuration with certain sectors sort of doing a little better than average. Consumer discretionary, communication services, financials, and energy in particular in the month of November are doing well. Which one did I not include? It's healthcare. And the reason is because you could argue that it could be grouped with one of these other ones. Healthcare is kind of a weird one, I found. It has sort of a mix of, pharmaceutical companies, biotech companies. So there's some offense, there's some defense. It's kind of its own thing. So I do look at the healthcare sector. It's not doing particularly well on a relative basis, so I'm not including it in this particular discussion. All right, now we're going to talk about the second way that I look at these relationships, which is start to look at comparisons between the two, and we'll look at one of the ways that I think about offense versus defense. Before I do that, just a heads up that if you are interested in what I'm doing in my work, I actually do a live market recap show called Chart This with Dave Keller. You can find that on my YouTube channel, which is called Market Misbehavior. I do a daily market recap show. I live stream that right at the close on YouTube, on X, on Facebook, and on LinkedIn. And I also have a podcast, and I think I just did our 11th episode talking with John Kosar of Asbury Research. But I've had some really fun conversations with some incredibly talented investors, guys like Mark Skusen, known as America's Economist, Peter Schiff, Mike Turner, a mathematician turned trend follower, and some of the technical analysts that you probably know, like Ari Wald, Tyler Wood, John Kosar, Mark Newton. Really excited to be building out these conversations, and you can get my market recap show and my market misbehavior podcast on my YouTube channel called Market Misbehavior. So please check it out if you could. All right, second second tool that I will talk about in terms of analyzing sector rotation is by comparing two of the sectors relative to each other. So far we've been looking at just relative performance of each sector versus a benchmark. Now we're actually going to look at sectors relative to each other. And we can do that by just doing a simple ratio of one ETF versus the other. So if this is the XLY versus the XLP, so consumer discretionary versus consumer staples. If this line is going up, that means consumer discretionary is outperforming. If the line is going down, consumer staples is outperforming. And if the line is going sideways, that means they are basically doing the same thing, or they're very similar in their movements, and neither one is outperforming. Now, why is this particular ratio important? This was inspired by conversations I had years ago with Bill Doan, who actually ran the Fidelity technical research team in the 1970s. And he would talk about ways that they would look at offense versus defense. And now they used a series of indexes which are no longer available. They were published back in the day in Barron's or something like that. But a modernized version of kind of what he was trying to do is by looking at, you can do that by looking at the relative performance of these two ETFs. Now, why do we look at these two? The argument, as Bill put it, is it's things you want versus things you need. It goes back to the defensive sectors that we talked about earlier, right? Those are things you need, right? No matter what, you're still going to buy toilet paper and beverages and cleaning products, right? But things you want are things you only do when you feel like you have money to spend and you're kind of in a good position. And so the XLY represents things you want. The XLP represents things you need. We're looking at that ratio by comparing these two ETFs. Now, the problem with the top ratio is the XLY and the XLP are cap-weighted indexes, cap-weighted ETFs. So the XLY is dominated by three stocks: Amazon, Tesla, and Home Depot. And so the problem is they're really overweighted to those three names, I would argue. So in the bottom series, I'm actually doing the equal-weighted ETFs for those two sectors. So RSPD is an equal-weighted consumer discretionary ETF. RSPS is an equal-weighted consumer staples ETF. So same concept, same idea. And you can see, generally speaking, they move in a very similar fashion. But I, generally speaking, tend to focus on that bottom panel because it eliminates that overweight in some of those mega cap consumer names. So what are these ratios telling you? What's telling me in the last 3 months that offense over defense has been the story. The reason why this ratio is so important to watch is what I found at major market tops. You will often get a rotation from offense to defense, right? When investors start to perceive a rockier period, when they start to perceive a weaker conditions going forward, and they think consumers are going to start to change their behavior, they start to sell out of the offense and buy some of the defensive sectors like consumer staples. So if you see that ratio turn lower, that usually indicates investors, institutional investors, are rotating more to defensive positioning. That means they are sort of expecting the market to go lower, and they want to cushion themselves from that potential market downside. So as a result, this ratio is key, I would argue, for really understanding that concept of sector rotation. For now, in terms of the readings in mid-November, I would say it's still very bullish, right? Because you can see both of these ratios making new 52-week highs in the month of November. I would say until these ratios start to rotate lower, conditions are pretty good. The last time you had a big rotation lower in these ratios were in July of 2024, which was probably arguably the last major big pullback we had for the S&P 500. So that's one example of what we can look at. There are a bunch of other ratios we could consider, but this is the one that I usually start with. Classic look at offense versus defense. And again, for now, still favoring offense, but that's why I think it's an important one to watch. Now we get to, I would argue, one of the most important visualizations that I've learned about here in the last 24 years of doing this, which is the RRG. I remember talking with Julius DeKempener years ago and seeing an early version of RRG, and it immediately resonated because it took this concept of sector rotation, and instead of thinking about rotation as we look at all those charts, this actually shows the rotation visually, which I think is a brilliant, simple but very powerful way of representing these 11 S&P sectors rotating around the benchmark. So if you really want to learn more about this visualization, Julius DeKempener does his own videos on this channel, and they're very well done. He's the expert, so I would encourage you to follow his work on StockCharts. But I will tell you how I use this visualization. I've used it for many years. The idea is you're looking at how the 11 S&P sectors are rotating around the benchmark, and the benchmark, the S&P 500, is at the crosshairs, right in the middle of the visualization. When things are outperforming and the momentum is strong, they are in the leading quadrant, and they are heading northeast, right? They're sort of improving, and the momentum is accelerating. When the sectors are still outperforming, but the momentum is slowing down, they rotate down in a clockwise direction to the weakening quadrant. When sectors are underperforming on strong negative momentum, they rotate to the lagging quadrant. Then when they're still underperforming, but the momentum is lightening up, they get into the improving quadrant. The idea is, and you can actually put this in motion, you can actually see over time how the sectors are actually rotating. Look at what's happened now just in the last 6 weeks or so. And I'm just kind of rewinding and fast forwarding to the current data so we can see this movement. Look at these defensive sectors like utilities and real estate. Back here in where is this, kind of mid like September, you see they're both in the leading quadrant heading northeast, and then look what happens soon after. They've now rotated and are now heading southwest, and they're in the weakening quadrant. So there was a rotation to some of the defensive sectors in September, but now that's been alleviated, and they've actually lightened up. So what's taking their place in a position of strength? It's these sectors here: consumer discretionary, financials, industrials, communication services. Do those sectors sound familiar at all? Remember the first set of charts that we talked about? We looked at some of the sectors that were improving. Most of those are the ones that I just mentioned. So the RRG obviously picking up on that improvement in relative strength that we saw looking at the individual charts. But this on one visualization kind of summarizes those first three charts, I think, in a brilliant way. Energy is another one to think about because this is still underperforming, but the improvement is really starting to follow through. And so that's the probably the most impressive, best improvement award would be for the energy sector here over the last 6 weeks, starting to accelerate. Now that ratio analysis that I did, looking at offense versus defense, you can also do that on the RRG as well. And what you do is you just select multiple sectors from the list at the bottom. So here we have consumer discretionary and consumer staples. I've selected those two. Now when we rotate them, just like we were looking at the ratio kind of sloping upwards and suggesting that these were in uptrends, now we can see how they're spreading out, how the XLY is leading, how the XLP is lagging. What you would look for is for the XLY to rotate lower, for the XLP to rotate higher. That would probably coincide with the previous chart kind of breaking down a little bit. And that would be what I'm looking for here. For now, it's arguably still in pretty good shape. Another ratio, by the way, that you can look at would be technology versus utilities, the XLK and the XLU. We can see a similar kind of phenomenon, right, where the XLU was leading in mid-September. It's defense over technology as offense. Look what's happened into the elections and now after. Utilities rotating lower, technology now heading northeast generally, although it came off a bit in the last week, and it's in the improving quadrant. So I would say, to summarize this look at relative strength and sector rotation, I think you're generally seeing offense over defense. I think the reason why that's important is just to reflect on the strength that we've observed in the market conditions, but also to recognize that at some point that is going to change. And I think the reason why you follow these sector rotation types of charts is to recognize when conditions change. Look for those offense versus defense comparisons to start to rotate. And if you take nothing else away, I would say use the RRG. Keep an eye on that every day, every week. It's part of my daily routine and certainly part of my weekly analysis. And what I look for is that rotation to start to see some potential changes. Generally speaking, focus on sectors that are in that in that leading quadrant, and certainly ones that are in the improving quadrant, starting to emerge with new signs of strength. That's often where some of the best opportunities could be. What do you think about these tools to track sector rotation? Anything I missed or anything you use to track sector rotation? Drop a comment below and let me know. For Sierra Alpha Research and Market Misbehavior, I'm Dave Keller. Remember, it's always a good time to own good charts.